Welcome to the deep dive. Today, we are opening up the financial toolkit. I mean, the one that professional advisors and lenders actually use, and we are basically giving you the key.
hmm
This deep dive is all about the bedrock of personal finance. We're talking about understanding exactly how money flows in and out of a household, how to harness that flow, and maybe most crucially, how financial institutions assess your entire financial life when you ask to borrow money.
That's right. Our mission today is to give you a true shortcut to financial mastery, and we're doing that by extracting the most vital principles from some pretty complex financial training materials.
Okay, so where do we start?
We are starting at the absolute foundation, the personal cash flow statement, and from there, we'll meticulously move through the sophisticated, and I should say sometimes counterintuitive, metrics that lenders use when they evaluate borrowing capacity.
We have some incredibly comprehensive source material here. I mean, it covers everything from the almost forensic mechanics of tracking income and expenses. We are going to get into the famous 12 clusters
Oh, yeah.
to the legendary 5 C's of credit and the surprisingly complex pitfalls of, those standard debt service ratios. So if you want to master your own money or just, I don't know, dominate a meeting about consumer finance, this is the blueprint.
The goal is crystal clear. By the end of this, you will understand how to shift your personal cash flow from, let's say, neutral or even negative into a sustainable surplus.
Right.
You'll know how to navigate the modern credit landscape, which is driven by both regulation and AI, and you'll know exactly how a lender views your financial profile. And this understanding is really non-negotiable because consumer credit is just so deeply interwoven with nearly every aspect of modern life.
Okay, so let's jump in. Right at the start, you said cash flow, the core engine.
The core engine of wealth creation. Cash flow.
Okay, so let's unpack this foundational concept then. The cash flow statement. It's the essential financial snapshot.
It is. It's what reveals the true health, the true habits of a household. When an advisor first sits down with a client, this is the very first document they construct.
Why is that?
Because it answers the three essential questions you need for building any budget. 1, how much money is there? 2, where exactly does it come from? And 3, where, down to the last penny, does it go?
And the math, I assume, is pretty straightforward.
The math here is simple, but it's sacred. It's just net income minus expenses equals your resulting cash flow.
And that number can be positive or negative.
Right. If it's positive, you've got a surplus. If it's negative, you have a shortfall. And we just cannot overstate this. The single major goal of all responsible financial planning is to consistently generate a cash flow surplus.
That's the fuel.
That surplus is the fuel. If it is regularly invested in assets or used to reduce liabilities, your net worth inevitably increases over time, period.
That sounds simple in theory, but I think the complexity comes in, distinguishing between where you are and where you want to be. Our sources highlight that advisors are dealing with two distinct types of statements, the current versus the projected. What's the key difference there, and why do you need both?
The difference is really about time and intent. So the current cash flow statement is historical. It's a backward look, typically covering the last 12 months.
It's a diagnostic.
It is a diagnostic tool, exactly. It assesses the household's historical ability to generate positive flow, and it identifies specific areas where expenses, could have been reduced. You just can't make a plan until you know exactly where you are standing.
And so the projected statement, that builds on the diagnosis.
Precisely. The projected statement is the forward-looking plan. It is the budget. It's a forecast of expected income and a deliberate, very disciplined allocation of expenses and savings for the upcoming year.
So it's designed around specific goals.
Exactly. Quantifiable financial objectives, whether that's saving for retirement, a down payment, debt reduction, you name it. The current statement reviews the reality. The projected statement dictates the action plan.
Got it. Okay, so to build either of those, you have to start with the money coming in, the income.
You have to analyze the income data, which is the positive side of the cash flow ledger. This means gathering documents like pay stubs, tax slips, your T4s, T4As, bank statements, leases for any investment properties.
And there's a note here for advisors.
Yes, a very important note for any potential advisors listening.
Yeah.
This is intensely personal data. Tact and discretion are absolutely mandatory when you're requesting these records.
So let's talk about reliability. Because if you're a financial institution, you need to know that the money coming in is going to be there next month and the month after that.
Yes.
Our sources use this volatility scale to determine the quality of income. Where does a lender place their highest trust?
They place their trust in stability. So income from a good, secure job at a stable organization, your regular salary or wages, that's considered the most reliable and predictable income source. It's the bedrock.
And I imagine as we move away from that stable salary, things get a little sketchier and quick.
They do. Investment income, for example, is inherently less reliable. It's subject to market fluctuations. If a client is living off a dividend portfolio, that income is seen as volatile.
And what about registered accounts, like a TFSA?
That's a great question. Income derived from registered accounts, like a tax-free savings account, is usually excluded entirely from a lender's calculation for capacity.
Really? Why is that?
Because those funds are often prioritized for long-term goals, like retirement, and they're not seen as available for immediate debt servicing.
Okay, that's interesting. What about government support? We have all these different programs, child tax benefits, renovation rebates. Do lenders treat them all the same?
Oh, absolutely not. The key is recurrence. Something like a child tax benefit or a basic pension payment is generally seen as reliable and predictable year to year.
But a one-off payment.
A one-time payment, like a renovation rebate or a specific government grant, is completely unreliable for long-term budget planning. It's treated as a temporary positive cash flow, not recurring income.
I noticed business income is ranked pretty low on the scale, even if the client has owned the business for years. Why is income from a small business considered inherently less reliable than, say, a mid-level manager's salary?
It's about variability and liability. A small business owner's income is often highly cyclical, it's subject to economic downturns, and it's reliant on the owner's health and effort.
And there's more risk.
A lot more risk. The lender also worries about potential business liabilities that could suddenly fall into the individual's balance sheet. It just requires deeper scrutiny. And then beneath all of these, at the very bottom of the reliability scale, is other income.
Which is the most volatile.
The most volatile category of all, yes.
This is where we bring in that case study of Peter and Suzanne Pirelli. They both have stable salaries, which is great. But Suzanne also earned some income from selling quilts at a local craft fair last year.
Right.
Why would the advisor categorize that quilt money as other income, even though she earned it?
Because it fails the predictability test. It was a first-time thing, and Suzanne is uncertain about whether she'll repeat the effort or if the market for her quilts will even be there next year.
So it can't be relied upon.
Exactly. That income cannot be factored into the projected budget or their debt capacity. It's an excellent illustration that income quality, not just quantity, dictates its usefulness in financial planning.
That makes perfect sense. Now, let's quickly differentiate income from something the sources call other sources of funds. They make a point that this distinction is crucial to avoid, well, disaster. What are these other sources, and why do advisors need to scrutinize them so carefully?
Other sources would be things like the sale of an asset selling stocks, selling a car, or a one-time withdrawal from savings.
So it's cash, but it's not income.
It is positive cash flow in the moment, but it is absolutely not income. The danger is that these sources can mask a profound cash flow problem. Well, if a client is consistently selling off assets or tapping into their long-term savings just to cover their monthly expenses, their true recurring cash flow is actually negative regardless of the temporary influx of cash from the sale.
They're just liquidating their net worth to live.
Precisely. An advisor has to track this to prevent the client from basically eating their own net worth simply to sustain a deficit budget.
Okay, so that's the income side. Now let's talk about the money going out, the expenditures.
If income is the engine, expenditures are the distribution system. We have to rigorously track negative cash flow where the funds went. And this data is extracted from every possible source: checking records, credit card statements, tax returns, insurance, and mortgage records, all of it.
And to make it actionable, you cluster it.
Yes, you cluster it into 12 specific categories for a really detailed analysis.
This is the part I find fascinating because it forces a level of accountability that just, looking at a bank statement doesn't really achieve. These 12 clusters are like the listener's checklist for self-assessment. Let's walk through them and maybe highlight some of the specific details the sources demand.
Let's do it. We can start with the largest and least flexible category. Number 1, housing.
The big one.
This dominates the average budget. It includes everything that keeps the roof over your head: mortgage payments, property taxes, utilities, insurance, routine maintenance, and even the cost of, say, new furniture or appliances.
And not much flexibility there.
Very little flexibility for cutting costs because it's so large and often locked into contracts.
Okay, next is food, which seems straightforward, but I think there's a trap.
Number 2 is groceries. This covers food, drinks, general household items like cleaning supplies, paper goods. The trap, as you say, is ensuring that if you categorize dining out in the later leisure cluster, you don't double count restaurant spending here.
Right, the account once rule.
That rule of account once is absolutely paramount.
Okay, what's next?
Move into personal items. Number 3, clothing. This is highly variable. It covers everything from necessary work clothes to expensive seasonal buys, including cleaning and repair costs.
So an area with lots of room for cuts.
Significant cuts because the spending is often driven by want rather than need. Then number 4 is transportation. This covers commuting and travel. So personal or leased vehicle costs, fuel, maintenance, insurance, public transit passes, taxis, parking.
And there's a nuance here about bikes.
Yes, a critical nuance the sources point out. A bike used for commuting is logged as a transport expense, even though bikes are sometimes considered leisure items. Context matters.
Health is next, and the data collection here seems to require some precision to avoid, well, misleading totals.
Right. Number 5, healthcare. Insurance premiums, dental costs, pharmaceuticals. The crucial rule here is avoiding double counting. If the client's health costs are already deducted from their payroll, or if insurance refunds a medical cost,
You only count what you actually paid.
only the net amount the client actually paid out of pocket should be recorded here. Failure to do that really inflates the necessary expense total.
Okay, what's 6 and 7?
6 is child or parental care. So daycare, babysitting, nannies, or costs associated with caring for an aging dependent parent. This cluster is, entirely contingent on the client's family situation. And 7 is personal grooming. Hair care, manicures, cosmetics, gym memberships.
Another area where you have to be careful not to double count with groceries.
Exactly. An advisor has to make sure basic toiletries haven't been erroneously lumped in with groceries.
Okay, so then we get into education and leisure, which seem like areas with a lot of discretionary spending.
For sure. 8 is education. Tuition, books, school fees, and related living expenses, unless those living expenses are already captured under housing. An important note for the advisor here is to remind the client that many of these costs carry significant tax deductions or credit. 9 is leisure. This is the fun bucket. Entertainment, hobbies, sports fees, travel, vacations, subscription services like streaming platforms. This cluster is almost entirely discretionary and is usually the primary target for generating a cash surplus.
Okay, then we get to the future-focused clusters.
Right. Number 10, savings and investments. This captures regular intentional contributions, RESPs, annuities, non-pension investments, or permanent life insurance payments that build cash value.
But it gets tricky with employment deductions.
It does. We have to account for mandatory employer deductions, like Peter Pirelli's required pension contribution, which is listed on his pay stubs as a deduction, not an expense. We have to calculate the client's total savings effort, incorporating both employer deductions and personal contributions, to get the true figure.
And the last 2.
11 is debt reduction. This is the total money going towards servicing outstanding liabilities. Payments on credit cards, personal loans, lines of credit, and interest payments. This also includes any payments toward life insurance loans or unpaid tax liabilities. And finally, 12 is miscellaneous. The catch-all category for things that don't fit neatly: pocket money, gifts, and donations.
With donations, I guess you have to cross-reference the tax situation?
You should, yeah. The advisor should cross-reference donations against the income statement as they provide tax deductions.
That is an incredibly detailed structure. But the main takeaway, like you said, is that simple but essential rule: account once.
If you follow the 12 clusters religiously, that rule prevents any fudging or inflation of your total expenditures.
So once all the clusters are populated, the analysis begins. This is where you separate the fat from the muscle, right? Basic versus discretionary expenses.
Exactly. Basic expenses are non-discretionary. These are the costs you absolutely must pay to maintain your standard of living: your mortgage, utilities, essential groceries, and loan minimum payments. You just can't cut these without a severe lifestyle change.
And discretionary expenses, that's where you have the flexibility. These are the easier targets for reduction.
Right.
Leisure, private schooling, non-essential home renovations, expensive grooming habits, or maybe even excessive savings contributions.
Although reducing savings is often counterproductive. But yes, this is the focal point for any client who's seeking to quickly generate a surplus.
But the classification isn't always rigid. There's a lot of nuance.
The nuance is critical. we can't just call clothing discretionary, but the amount spent on clothing is absolutely discretionary. A client needs work clothes, that's basic. But buying an expensive new designer suit, that's discretionary.
Our haircut example.
Exactly. A $30 haircut is basic grooming. A $300 salon visit is a discretionary expenditure on a basic need.
That seems like it requires some deep communication and tact from the advisor, doesn't it? What if a client insists that a typically discretionary item is essential? I'm thinking of Suzanne Pirelli, who considers her health club membership essential for stress management.
The advisor has to use careful judgment. I mean, if the client genuinely deems the expense essential for their health or their productivity, like Suzanne's membership maintaining her professional capacity, the advisor has to respect that, at least to a degree. You can't budget for a breakdown.
But the total picture still matters.
The total picture matters. If a client is spending, say, 90% of their income in the basic category, the reality is they have very little ability to reduce expenses short of selling their home. But if a client is at 50% basic expenditure, there's vast untapped room for cuts in those discretionary areas. It's a proportional assessment of their financial maneuverability.
It makes me think about that $30,000 the Pirelli family was spending in the groceries and restaurants cluster. I mean, basic groceries are non-discretionary, but the proportion they spent on restaurants and high-end specialty foods, that's incredibly discretionary. That money is the target.
And the budget, the projected cash flow statement, is the tool we use to redirect those funds. The core activity here is shifting the household's focus from passively watching where money goes to actively deciding where it should go and generating that cash surplus that drives net worth growth.
And we established there are two ways to get there. One is to increase income, which is often capped by your career path or opportunity.
Right.
The other, and usually the most effective focus for a household, is to aggressively reduce expenses, particularly in those discretionary clusters.
And the process is formalized into 3 clear steps. This makes sure the budget isn't just some abstract idea, but an actionable, measurable plan.
Go with step 1.
Step 1, set your savings goal. You review the current cash flow statement, the diagnostic, to determine your starting position, your current surplus or shortfall. Then you set realistic, quantifiable goals. Save X for retirement, pay off Y of debt. This goal dictates the target amount you need to cut from spending to add to savings.
You have to know the destination before you cut the path.
Exactly. Then, step 2, adjust your expenses. This is the hands-on, often painful process. You divide all 12 clusters into basic and discretionary, and you execute the cuts. If the goal is $12,000 in cuts, you go through the leisure, groceries, and grooming clusters and make specific changes, cutting 2 takeout coffees to 1 or eliminating cable.
And that creates the projected budget.
You then create the projected budget where the new, lower adjusted expenditure, combined with your savings, balances perfectly with the projected income.
And it's not a one-and-done thing.
No, absolutely not. Step 3, review monthly. Financial discipline requires constant calibration. At the end of each month, the client has to compare their actual spending against the projected budget. Did they exceed the target for groceries? Were the savings goals unrealistic?
And you adjust from there.
This comparison forces adjustments, either changing spending habits or adjusting the budget targets themselves, and it keeps the household actively engaged in striving toward their goals.
Okay, so now let's move to the tactical level. For our listener who wants immediate actionable steps, the advisor in our sources, Brian, gave 14 highly effective tips to the Pirellis to help them stay on track.
Wow.
And these aren't just, generic platitudes. They seem like battle-tested strategies for behavior change.
The first one is foundational. Set specific short and long-term goals. Without a clear target, savings just become a vague hope.
The second one is fantastic behavioral advice, especially for anyone prone to overspending. Overestimate expenses and simultaneously underestimate income.
I love that one.
It creates a built-in safety cushion, ensuring you're never caught short when unexpected costs come up.
Yeah.
It's the opposite of wishful thinking.
Number 3 is about minimizing erosion. Know your money. Avoid bank fees. Monitor your accounts closely. Set low balance alerts to prevent unnecessary charges and fees.
Tip 4 is critical for anyone carrying high-interest debt. Prioritize debt payment aggressively. The sources give 3 rules of thumb here. 1, always pay off the debt with the highest interest rate first. 2, look for opportunities to convert high-interest, non-tax-deductible debt into tax-deductible debt. And 3, increase the frequency or amount of payments.
That biweekly payment trick can make a huge difference.
Huge. Okay, number 5.
Number 5 is the legendary pay yourself first. As soon as income lands in your account, you automate a transfer to savings or investments. By making savings non-negotiable and automatic, you treat it like a bill, forcing you to live off the remainder.
Then we get into the big lifestyle cuts. Tip 6 is to actively trim expenses. This means evaluating the cost of luxury items that have become necessities. Considering going without a car, cutting high-cost cable or landlines, consolidating debts, eating out less, traveling off-peak, this is those discretionary clusters in action.
Tip 7 focuses on efficiency. Share what you can. Use auto-share services, pool expensive tools with neighbors, or even consider shared living space if it's feasible. This reduces the capital outlay for individual ownership.
8 and 9 are about structure. 8, keep separate spending and savings accounts to psychologically separate your now money from your future money. 9, implement disciplined savings or investment plans through pre-authorized payments.
10 is about optimization. Reduce insurance coverage if you are overinsured. This means increasing your deductible or asking for multi-line discounts from the provider. You save premium costs, but you have to accept more risk.
And the last 4 are pure behavioral nudges. 11, pay with cash for small purchases. Makes the spending more tangible. 12, the match funds rule: for every dollar you spend on leisure, put a matching dollar into savings.
That's a powerful one.
13, save unexpected cash. Bonuses, tax refunds, windfalls, they go straight to savings or debt reduction. And 14, the serious caveat: do not skimp on healthcare.
A very important one. Basic preventative care prevents incredibly costly and emotionally damaging medical issues down the road. It's one cost cluster that really should be protected.
Okay, so to bring this all together, let's go back to the Pirelli family's challenge. We noted their net after-tax income was about $136,000.
Right, 136, 368.
But their total spending, even including their current low savings, was $143,500. They were in a $7,000 deficit.
Yeah, living off that volatile quilt income or dipping into savings.
So to hit a respectable 10% savings goal, which is about $13,600, they needed to cover the $7,000 deficit and find another $13,600 in savings.
Meaning they had to cut approximately $20,600 from their current expenditures.
That's a huge cut. But when you look at the 12 clusters, the targets become really clear. Their groceries and restaurants cluster was $30K, leisure and vacations was $15K, and clothing and grooming was $10K.
That's $55,000 right there in highly discretionary spending.
Exactly. So if the advisor targets just a 30% reduction in those 3 categories alone, they can pretty much hit their $20,600 goal.
And that's what the budget process does. It forces the client to see that spending on restaurants isn't abstract. It's the direct reason they can't save for their retirement or pay down their mortgage faster.
Okay, so that's the budgeting side. Let's transition now. From controlling your own money to accessing money from an institution, we're entering the world of consumer lending.
And this industry is undergoing constant, rapid evolution. It's driven by shifts in regulation, economics, and technology. An advisor who isn't current on these factors is, frankly, providing outdated advice.
On the regulatory side, the trend seems pretty clear: greater consumer protection. We've seen stricter laws enforced by agencies, mandating much clearer disclosure for all credit terms and conditions.
Lenders have to be explicit about rates, fees, and penalties now. And beyond just disclosure, regulations have established limits on punitive rates and fees, alongside stronger rules governing debt collection practices. The goal is to make the process fair and transparent to prevent predatory behavior.
We also hear a lot about credit reporting reforms. What are those specifically targeting?
Accuracy and transparency. Efforts are constantly underway to improve the fidelity of credit reports and grant consumers greater control over how their personal data is used. Everyone who interacts with credit benefits from a more reliable system.
And then there's the massive apparatus of anti-money laundering AML and Know Your Customer KYC. This isn't just about financial institutions. This affects how you open accounts.
Oh, absolutely. These regulations require rigorous identity verification when you're establishing a relationship and continuous transaction monitoring to prevent fraud, terrorist financing, and illicit transactions. It adds some friction to the process, but it's necessary for maintaining the integrity of the financial system.
Economically, the industry has also responded directly to rising consumer debt. Stress testing is a perfect example of a regulatory response to that economic risk.
The stress test, yeah, particularly for mortgage approvals, was designed to ensure that if interest rates were to rise significantly, the borrower could still handle the payments without defaulting. This was a direct response to high household debt levels, and it injected a measure of stability into the housing market.
And we can't forget the impact of major economic shocks like
Mhm.
2008 or the COVID-19 pandemic. How did the lending landscape adapt to those immediate pressures?
They forced temporary adjustments. We saw widespread loan deferrals during the pandemic and immediate changes to credit reporting standards to protect consumers who faced sudden, unavoidable hardship. These crises really reveal the fragility of the system and force institutions to create adaptive mechanisms to prevent mass failure.
So that's the regulatory side. But technology is maybe the most visible disruptor here. The rise of digital banking, mobile apps, fintech companies,
hmm
the robo-advisors,
Yeah.
it completely revolutionized how we interact with credit.
The key shift is speed and automation. Online platforms have streamlined the application process dramatically. We've moved away from lengthy paper applications to automated underwriting, where machine learning and big data algorithms assess risk almost instantly.
And that's improved consistency, I imagine.
It has, yeah. Not only has it improved efficiency, but it's arguably improved the consistency of risk assessment.
This speed has led to innovations in credit scoring. I know the traditional models are still dominant, but we hear more and more about alternative data. What does that mean, and how is it used?
Alternative data refers to non-traditional financial markers used to assess creditworthiness. So this might include things like your utility payments, your rental history, or even employment data that doesn't traditionally flow into a credit bureau.
And what's the goal with that?
The goal of this innovation is to expand credit access to individuals who might have thin files or limited credit histories, like new immigrants or young adults, by giving the lender a more holistic view of their financial responsibility.
And artificial intelligence is now running everything, from the back office to customer-facing wealth management.
Yes. AI is used heavily for fraud detection, for internal auditing, and in the wealth management space, it's used to anticipate client attitudes, needs, and behavioral patterns with much greater accuracy than traditional statistical models. It aims to predict not just if you can pay, but how you will use the credit, and then tailor the offering accordingly.
But this immense technological power comes at a cost, leading to what our sources call the privacy paradox.
It's the trade-off. It's the trade-off between convenience and data security. While technology provides efficiency and instant access to funds, the public faces significant, very legitimate concerns about the scope of data collection and privacy intrusion.
And that's leading to new laws.
This constant tension is leading to new government laws like data protection legislation, and it's forcing the industry to adopt stricter self-regulation and internal codes of conduct to maintain consumer trust.
So with all this technology, where does that leave the human advisor? Our sources suggest two sides to the coin, a massive opportunity and a massive challenge.
The opportunity lies in consolidating the client relationship. Because the primary financial institutions offer such a vast range of integrated services, from checking accounts to mortgages to wealth management, the advisor has the potential to provide a complete, tailored financial solution to a single client. They can become the client's financial quarterback.
But the challenge is the sheer ferocity of competition driven by fintech.
Mm.
Client loyalty, which was once sort of taken for granted, is now easily shattered.
Mm.
If the client can get a better rate on their phone in 5 minutes, they will shop around. We saw this with Kareem and Aziza Ali, who intended to shop the market before calling their advisor for their mortgage renewal.
And this forces the advisor to elevate their value beyond just transactional services. The only sustainable solution is to be relentlessly knowledgeable, transparent, and above all, trustworthy. This means proactively looking out for the client's absolute best interests, even if it means less immediate profit for the institution.
And that's the key takeaway from the Ali case, right? Their advisor, Brian, didn't just offer them a competitive rate.
No, he did more.
He gained their loyalty by suggesting an accelerated payment schedule, showing them exactly how they could save tens of thousands of dollars in interest and shave years off their mortgage.
That's relational advising. It's moving beyond here's the product to here's how this product fits into your life plan. That level of proactive service builds the deep loyalty that's necessary to survive and thrive in this hyper-competitive lending environment.
Okay, so that sets the stage. Let's get into the nitty-gritty. The ultimate test of financial mastery comes when you approach a lender. Before they advance any credit, they run the 5Cs test to quantify their risk.
Hmm.
Understanding these 5 criteria is really the definition of knowing thyself as a borrower. Let's break down each one.
The 5 Cs are the framework used by every credit analyst. First is character. This is the lender's assessment of the client's honesty, reliability, and most importantly, their intention to repay the debt.
And how do they judge it? It sounds so subjective.
It's judged qualitatively by things like residence stability, your employment record, the stated purpose of the loan, and their existing debt load. Lenders are looking for signs of stability and responsible intent.
Okay, second C.
Second, capacity. This is the cold, hard number. The ability to actually generate the cash flow required to repay the loan. This is assessed by current income, the stability of that job, the predictable nature of that income, like we discussed in Part I, and any future financial considerations that might impact that income flow.
And third is credit.
Right. This is a look at the borrower's history, which is seen as the single best indicator of how they will handle future debt. Lenders scrutinize payment history, how much existing credit is currently being used, any past delinquencies, and any public record judgments or outstanding debts.
Fourth.
Collateral. This is the property or asset pledged to secure the loan. If the loan amount is substantial relative to the borrower's net worth, collateral provides the lender with security. If the borrower defaults, the asset is liquidated to cover the outstanding balance. It turns an unsecured risk into a secured risk.
And finally, number 5.
Finally, the 5th C, capital, also known as equity or financial capital. This is the client's net worth, their total assets minus their liabilities.
And that serves 2 purposes.
It serves 2 main purposes. It's viewed as an extension of character, signaling good financial management, and it acts as a secondary source of repayment. If the borrower loses their job, disrupting their capacity, the lender knows there is capital they can liquidate before they have to resort to seizing collateral.
What's fascinating here is that the C's are not a rigid scorecard. A weakness in one area can be offset by a strength in another.
Mm-hmm.
We saw this with Vikram Patel, the cameraman. Cameramen often work in contracts, which means employment gaps and lower capacity. Yet he was approved for a line of credit. Why did the lender still say yes?
Because the lender used judgment. Vikram had 0 existing debt and a spotless credit report, which demonstrates high character and credit.
Okay.
More importantly, he had substantial home equity, providing the necessary collateral and capital. So his stability and track record, his credit and character, and his secondary source of repayment, his capital and collateral, were strong enough to mitigate the risk posed by his volatile income, his low capacity.
So the 5 C's have to be viewed holistically?
They must be viewed holistically, not independently.
Okay, so the credit bureau is the organization that collates the specific data used to assess the 5 C's, particularly character and credit.
Right. Every time you apply for credit, a file is generated. Lenders pay a fee to access this data to evaluate their risk.
That file then generates the credit score, what we commonly know as the beacon score. For our listener, what are the key mechanics of this score?
It's a 3-digit numerical value based on statistical analysis, and it ranges from 300 to 900. The average Canadian score hovers around 650.
And for mortgage?
If you're seeking a mortgage, lenders typically require a minimum score somewhere between 620 and 680 to proceed with standard underwriting. If you have no history whatsoever, no credit cards, no loans, your score is 0.
It's crucial that listeners understand what's actually contained in that report, because errors can severely jeopardize credit access. The sources list 5 critical elements found in the report.
The first is basic personal information names, current and former addresses, employer history. Second is the account history, which is the core. A list of every creditor you have dealt with and a payment history score, showing late payments, high usage, and so on.
An inquiry.
Third is inquiries, a record of every institution that has requested your report, which can impact your score if too many hard inquiries are made in a short time. Fourth, the damning evidence. Public record information. This includes bankruptcy filings, outstanding judgments, or property liens.
But you have a defense mechanism.
And fifth, yes, the consumer's defense mechanism, the consumer statement, which allows you to insert a personal 100-word comment to clarify specific information on the report.
And that's vital.
It is, because consumers have explicit rights. You have the right to request your file, verify its accuracy, amend any incorrect information, and know why credit was refused.
This brings to mind that case of Angela Gerhardt. She was denied a loan unexpectedly because of a poor credit report. It turned out she was a victim of identity fraud.
Right.
A credit card she never opened showed severe delinquencies. She was able to use her right to request the file, identify the fraudulent account, and start that arduous process of having it removed. It really highlights that these reports aren't just about your mistakes, but about external threats you have to monitor.
It's so true.
Okay, so moving from the qualitative, the 5 Cs, to the quantifiable, lenders use two specific ratios to measure debt capacity against industry standard guidelines: GDSR and TDSR.
The gross debt service ratio, GDSR, and the total debt service ratio, TDSR.
Let's start with the narrower one, the gross debt service ratio, or GDSR. What exactly is it measuring, and what are the standard limits?
The GDSR focuses only on the cost of housing relative to your income. The calculation takes your annual housing costs, so principal and interest on the mortgage, property taxes, heating costs, and 50% of any required condo fees as a percentage of your annual gross income.
And the limit.
The standard acceptable guideline for nearly all major lenders is 32% or less.
So if your housing costs alone exceed 32% of your gross income, the lender just says no, regardless of any other factor.
That is correct. It establishes the ceiling for manageable housing expenses relative to income. If it's too high, the client is deemed unable to manage the basic cost of ownership, even if they have no car payment or credit card debt.
Okay, so the total debt service ratio, or TDSR, is the comprehensive figure. This looks at total debt payments.
Right. The TDSR calculation is your annual housing costs plus your other annual debt payments as a percentage of your annual gross income. The absolute limit set by most lenders is 40% or less. If you exceed 40%, you are considered overextended.
This is where the mechanics of calculating other annual debt payments get fascinating and often surprising for the borrower. How does a lender treat lines of credit and credit cards in this calculation?
This is the most crucial mechanic the listener needs to understand. Automobile leases are included at their full payment amount. However, for credit cards and lines of credit, the payment is calculated based on a minimum of 3% of the total credit limit.
Wait, 3% of the limit, not 3% of the current balance owed.
Exactly. This is non-negotiable for the lender. The lender has to qualify the client based on their ability to assume the entire available limit at any time.
So even if the line of credit has a zero balance,
Even if you have a $50,000 line of credit with a zero balance, the lender assumes you are currently making a $1,500 annual payment. That's 3% of $50,000 for the purpose of the TDSR calculation. This is why having many open credit lines, even unused ones, can seriously impact your ability to qualify for a mortgage.
let's run that Ramona example to illustrate the impact. Ramona has $30,000 in annual housing costs on a $100,000 gross income. Her GDSR and TDSR are both 30%, so she has capacity.
Right.
She applies for a modest $25,000 line of credit.
The lender instantly adds $750 per month or $9,000 annually in assumed debt payments to her ratio, $25,000 limit times 3%.
So her total annual debt payments are now $39,000.
And her TDSR instantly jumps from 30% to 39%, bringing her right up to the 40% limit just by applying for and receiving an unused line of credit. It shows the immense power of that 3% rule.
Okay, so it is essential to remember that these ratios, while they are standard, are mathematical shortcuts, and they have serious documented limitations that require some critical thinking. If we just blindly rely on the 40% rule, we can miss serious financial stress points.
The first limitation is that these ratios only reflect the current situation, and they completely disregard the future variability of income. They treat income as constant. A doctor making $150,000 salaried and a highly commissioned real estate agent making $150,000 gross are viewed identically by the ratio.
But their risk is completely different.
Completely. The doctor's income is inherently more stable and can support a higher debt load than the agent's volatile, cyclical income. The ratio fails to capture that underlying risk disparity.
Second, the ratios don't account for the client's actual spending habits beyond debt payments. They fail to indicate short-term liquidity or long-term solvency.
Exactly. A high earner might have a low TDSR, but if they're spending $5,000 a month on luxury discretionary items, private jets, expensive hobbies, $300 salon visits, they might have zero cash left over despite the favorable ratio. The ratio doesn't know the difference between a high earner who is frugal and one who is living paycheck to paycheck on expensive luxuries.
And this is the major conceptual flaw that we have to challenge. The ratios use annual gross income, but debt payments are always made with after-tax dollars.
It creates a fundamental distortion in assessing true capacity.
If we know that marginal tax rates increase based on income, a single-earner household is fundamentally penalized by this gross income standard compared to a dual-earner household, even if their TDSR calculates exactly the same. So why do institutions persist in relying on growth income when we know this structural flaw exists?
It's a matter of administrative simplicity and tradition. Gross income is easily verified via the tax filing, the T4. Calculating a true, individualized after-tax debt capacity would involve estimating the client's effective tax rate, incorporating all deductions, credits, provincial differences.
Too many variables.
It just introduces too many variables for a standardized lending model. The system sacrifices accuracy for universal application.
But the result is huge. Our sources illustrate this perfectly. A family with one earner making $60,000 is taxed at a much higher marginal rate than a family with two income earners each making $30,000. While both families have the same $60,000 gross income, and thus the exact same TDSR, the two-earner family takes home significantly more after-tax income, giving them greater capacity to manage debt comfortably. The ratio is effectively harsher on the single high-income earner.
And finally, the ratios suffer from a lack of income applicability at the extremes. The standard 32 and 40% guidelines are only reliably applicable for average family incomes. A poor family making $35,000 gross cannot possibly afford 40% debt servicing. They would have zero left for basic necessities.
And the opposite is true for the wealthy.
Conversely, a wealthy family making $300,000 can likely afford to comfortably exceed the 40% limit, as their remaining 60% is more than enough to cover all basic needs and luxuries. The standard guidelines are just inflexible and require human judgment outside of that middle income band.
So that makes the TDSR a helpful screening tool, but a flawed final verdict. An advisor has to look at those 12 clusters and the after-tax reality before recommending a client push their debt capacity to the limit.
Absolutely.
Okay, so once creditworthiness is established, the final stage is choosing the right borrowing tool for the job. Let's start with credit cards.
Credit cards. They are essentially short-term, high-interest lines of credit offering funds up to a specified limit.
They require a minimum monthly payment, usually calculated as 2 to 3% of the outstanding balance. But we should note that regulatory pressure is increasing these minimums. For instance, Quebec is moving to a 5% minimum payment by August 2025.
They are also characterized by the highest interest rates relative to other consumer borrowing options, from, say, 11.9% up to 28% for certain co-branded cards.
And there's no collateral.
No. A key legal point. The institution has no legal claim on the items you purchase. Their security is only the cardholder's promise, their character, to repay.
The crucial insight here is what we dubbed the free LOC trick. How do you use a credit card as an interest-free loan?
You utilize the grace period. If the full outstanding balance is paid by the statement due date, typically 20 to 30 days after the statement is generated, you pay zero interest. It's an interest-free float for that duration. Interest only applies from the date of the transaction if the balance is carried past the due date.
So when you're comparing card types, the decision hinges entirely on the client's repayment behavior. If you are like Judith Monroe and you pay the balance in full every month,
the interest rate is irrelevant. You should focus on a card that maximizes rewards, like a travel card where the points offset the annual fee.
And the same for Lorenzo Del Bello, frequent flyer who always pays in full. He chooses a platinum travel card for the generous rewards and just ignores the 19.99% interest rate.
But conversely, if you carry a balance even occasionally, you must prioritize the lowest possible interest rate above all rewards, regardless of the annual fee or the reward structure.
We also have things like secured cards, which require a cash deposit to establish credit, student cards, and U.S. dollar cards, which are essential for frequent cross-border travelers to avoid paying those foreign currency conversion rates on every transaction. Okay, let's talk about personal lines of credit, or LOCs. They seem like a superior, more flexible option for revolving credit.
They are. They allow you to borrow funds, repay them, and reuse them, similar to a credit card, but with a much lower interest rate and usually a higher limit. And interest is only charged on the exact amount you've borrowed. They're excellent for emergency funds or for bridging short cash flow gaps.
And LOCs are defined by whether they are secured or unsecured. What's the rate difference?
The secured LOC offers the lowest rate, usually prime to prime plus 1%, because the borrower pledges an asset like investments or a vehicle as collateral, reducing the institution's risk. The unsecured LOC carries a higher rate, maybe prime plus 4.5 to prime plus 7%, to compensate the institution for taking on the risk without collateral.
The most powerful type seems to be the home equity line of credit, or
Ah.
HELOC. This is secured by the equity in the client's primary residence, the market value minus the outstanding mortgage. It provides a massive borrowing capacity at the lowest rates available.
But there is a specific government rule here that everyone needs to know. While the maximum amount of debt you can hold against your home mortgage plus ELOC is 80% of its market value, the revolving line of credit portion itself is capped at 65% of the home's value.
And the rest has to be a mortgage.
The remaining 15% must be structured as a traditional amortizing mortgage segment. This restriction prevents homeowners from leveraging too much of their primary asset into high-risk, interest-only revolving debt.
That's a critical distinction. Finally, there is overdraft protection. This is technically an unsecured LOC designed only for temporary account overdrafts.
And it is the most expensive type of revolving credit, often charging up to 21% plus a fee per overdraft event. It should only be used as a brief safety net and repaid immediately. It is never intended for sustained borrowing.
Got it. Okay, last category. Personal loans, also known as installment or term loans. These are fundamentally different because they are typically used for a single, large purchase like a vehicle, major debt consolidation, or a home renovation.
Right. They are repaid over a specified term with a fixed schedule of monthly payments, and most include an open prepayment clause, allowing early repayment without penalty.
And these can be structured as fixed rate or variable rate.
The fixed rate loan sets the interest and the payment for the term. The benefit is predictability. You're completely protected if interest rates rise. The drawback is you lose out if rates fall significantly.
And the variable rate loan sees the rate float with the prime rate. The payments are usually fixed, with a cushion, but the final payment adjusts or the term extends based on changes in the prime rate.
So the borrower benefits if rates fall, but pays more if rates rise. It's a gamble on future economic policy.
There are several specific types here. Vehicle loans are secured by the car itself. The debt consolidation loan is a really powerful application, combining multiple high-interest debts like credit cards and smaller personal loans into one lower-rate manageable payment.
This is exactly what Brian advised Elena Brancusi to use to clean up her scattered, high-interest consumer debts.
Then there is the investment loan, used to borrow money to purchase investments, hoping the after-tax return exceeds the cost of the loan. And there's a crucial tax note here.
Yes, interest paid on an investment loan used to purchase non-registered assets is often tax deductible. However, interest paid on an RRSP loan is not tax deductible.
And at the very bottom, in the high-risk category, we have paycheck advance or payday loans.
These are extremely short-term, secured by the next paycheck, and they carry exorbitant interest rates and fees. They trap consumers in endless cycles of debt and should be avoided at virtually all costs.
That brings us to the end of a truly intensive exploration. We've covered the entire spectrum, from the surgical precision required to track every cent in those 12 expense clusters to the ultimate assessment mechanics used by a lender through the 5 C's and the debt service ratios.
If you distill this entire deep dive down, the 3 most vital takeaways for your financial foundation are these. First, your personal cash flow management has to be forensic. You must accurately distinguish between volatile and stable income and rigidly categorize expenditures into the 12 clusters to reveal your true, sustainable cash flow surplus.
Second, remember the 5 C's of credit: character, capacity, credit, collateral, and capital. Lenders use human judgment, not just algorithms. A perceived weakness in your income capacity can be, and often is, offset by proven strength in your character and your capital base, like we saw with Vikram Patel.
And third, use the right tool for the job. Credit options are highly specialized. Utilize credit cards solely for short-term, interest-free float, use LOCs for flexible, lower-rate revolving access for emergencies, and use term loans for major fixed purchases where predictable repayment schedules are paramount.
And finally, for you to consider as you wrap up this mastery session.
We spent some time dissecting the major flaw of the standard debt service ratios. They rely on annual gross income, even though you have to pay that debt with scarce after-tax dollars. So, Here's the thought. If you were to recalculate your personal TDSR, not based on the institution's standard 40% rule on gross income, but based on a much tighter, say 25% guideline applied to your actual after-tax monthly cash flow, what unexpected pressure point in your current spending or debt load would that realistic calculation immediately uncover? This stress test might just reveal far less room for error than the lender's optimistic ratio ever suggested.